What is a credit score, and why does it matter? What factors are used to determine your credit score? All that coming to you right now on Windfall Wednesday, where we review basic principles to help the everyday person improve their finances. So, like and subscribe, and let's get to work. A credit score is a number that you get assigned that tells others how likely you are to pay what you owe. Scores can range from 300 to 850. The higher your score, the better you look to prospective lenders. There are many credit bureaus in the U.S., but only 3 really matter: Experian, Equifax, and TransUnion. These credit bureaus are responsible for gathering, analyzing, and distributing your information to the credit markets. The vast majority of lenders use the FICO scoring model along with data from one or more of these bureaus to determine your credit worthiness. There are 5 factors that go into determining your score, and we'll address them in order of importance. Payment history is the number 1 contributing factor to determining your credit score. It accounts for 35% of how your score is determined. As for payment history, pertinent information is as follows. Number of late payments. If the answer is none, you score perfectly on over a third of your criteria. Time taken to catch up on payments. A month, 3 months, more. How many months ago were the late payments? Any late payments will hurt your credit score, and the more late payments there are, and the more late they are, say 60-day or 90-day plus, the worse. On the more severe end, bankruptcies, collection accounts, charge-offs, foreclosures, and repossessions will wreck this part of your score. The good thing is that as time passes, payment history blunders become less significant, especially if you can string together a year or more of perfect payments, as in on time, all the time, with at least the minimum amount due. The second most important factor is responsible for 30% of your credit score: credit utilization. In other words, how much of your available credit limit are you using? This is especially important for credit cards. 30% or less is considered to be good credit utilization. That means if you have $20,000 of total available credit between all of your cards, you'll ideally have no more than $6,000 of outstanding credit card debt at any given time. The more debt you have beyond this, the less favorable it is for this part of your score. Other factors here include total amount of debt on the report, the number of open accounts with balances, and the distribution of balances among different types of debt, like mortgages, student loans, car loans, and credit cards. If you have a lot of open credit cards, you'll generally benefit from having 0 balance on at least half of them. In terms of distribution of balances, having most of your debt in car loan, student loan, and mortgages and less in credit card or personal loans is considered favorable. We still got 3 more factors that affect your credit score, and for those of you who stay to the end, I'll show you just what a good score is considered to be. You'll also find out what you don't need to worry about, things that don't affect your credit score at all. And just a quick reminder to like, subscribe, and share if you're getting value from this video. Next, we have length of credit history, accounting for 15% of your score. FICO scoring models factor in the ages of the newest and oldest accounts on your report, the average age of all accounts combined, the age of each individual account, when each account was last active. Older accounts as well as older average age of accounts helps your score. This one's mostly a waiting game. That is, unless you have a family member with an older and pristine credit card account who is willing to add you as an authorized user. This would help you to lengthen your average age of credit and can only help your credit score. Then there's new credit accounts, 10% of your score. It's considered common knowledge that checking your credit report might hurt your credit score. This one's pretty ambiguous, but it's definitely true in some cases. Prospective lenders consider how many recent credit checks or inquiries show up in your report. Whenever you apply for new credit, that lender checks a copy of your credit report. This counts as a hard inquiry. Hard inquiries show on your credit report for 2 years. Lenders differ on how they view this, but if they see 6 or more hard inquiries, most will frown upon that. And although not by much, each individual hard inquiry can affect your credit for up to a year, so it may be a good idea to space these out. Then there are soft inquiries. Most sources say that they don't affect your credit at all. Not all soft inquiries even make it onto your report. Background checks when you apply for a new job, an insurance policy, or even if you pull your report from one of the bureaus. Those are soft inquiries. So are mortgage pre-approvals. New accounts on the credit report are also factored in. Like hard inquiries, new accounts show on your credit report for 2 years, and only those up to 1 year old can individually affect your score. The best practice here is to only apply for new credit when you need it, or if you get an offer you can't refuse. And the last factor, good for 10% of your credit score, credit mix. This pertains to how diverse the types of accounts that show up on your credit report are. So having 10 credit cards only counts as one type of account. Examples of different types of accounts would be personal loans, mortgage loans, student loans, credit cards, and car loans. Though it generally doesn't benefit you to take on new debt just to improve your credit mix. And now that bonus for those of you who stay to the end. What is a good credit score? And what don't you need to concern yourself with regards to your score? Here it is. 800 to 850. Excellent. 740 to 799. Very good. 670 to 739. Good. Anything else is going to need some work. You'll generally run into at least some struggle getting good rates or even qualifying for loans when you drop below 700. The Consumer Financial Protection Bureau recommends that you check your credit reports at least once a year. The agency also says it's a good idea to check reports before taking out a loan, applying for a new job, and to protect against identity theft. You can request a free copy of your credit report from each of the 3 major credit bureaus: TransUnion, Equifax, and Experian. Once a year, by phone, mail, or online. You can find out more about annualcreditreport.com. I'll leave a link for you in the video description. Lastly, you need not worry about your bank account balances, your income, or your net worth. None of these factors play a role in determining your credit score. So you can apply for credit with a decent credit score before you get rich, which I guess is the whole idea. Leave your comments below. Your feedback helps me to improve the channel. Like the video, subscribe if you haven't already, and if you got value from this content, hit the share button to spread the wealth.